You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. Nadel is a proud sponsor of Lender Lounge. Nadel helps connect companies to end users through branded items, custom items, and creative solutions. They have collaborated with established, globally known enterprises and the most exciting up-and-coming companies to create unparalleled branded experiences. With attention to the smallest details, Nadel helps you pursue your biggest goals. Their founder, Jack Nadel, first began creating branded merchandise in Culver City, California in 1953. With Nadel, products and experiences are transformed into memorable brand moments. For some, that means providing something immediately useful, like the perfect notepad or eco-friendly water bottle. For others, it's more intangible. They're creating something of sentimental value to take your breath away. Whatever you're looking for, Nadel can make it happen. Perfect for trade show giveaways, new hire gifts, awards, and more. For inquiries, please reach out to Ben Goldberg at ben.goldberg@nadel.com. Hey guys, welcome to season 3 of Lender Lounge with yours truly, Kevin Kim. Today, we are interviewing a good friend and client, my friend Ryan over here from Saluda Grade. And, we're really excited to do this. We're doing it via Zoom, but, it's going to be a really great episode. So first of all, Ryan, why don't you give us a little bit of a little intro for our audience and tell us all about Saluda Grade, and we'll go from there.
Ryan Kraft, founder and CEO of Saluda Grade. Saluda Grade is a alternative asset, vertically integrated advisory and asset management firm. So we focus on non-traditional, inefficiently financed, under-optimized, real estate related or asset-backed asset classes. And we work to bring cheaper, more scalable institutional capital to those asset classes while betting on operating companies that operate inside of those asset classes.
Right.
So one of the reasons why we've become big clients and partners with Jurassic is we're heavily focused on the private lending space in the what we call the transitional mortgage lending world, which is rehab, fix and flip, construction for both single family and multifamily housing.
Yeah, and I remember when you guys, we started seeing you guys at the shows and clients started mentioning you guys back in, I think it was like 2019, and then you guys made a big splash in 2020 with your first securitization. Like, it was very interesting because at the time, we had a lot of folks that were coming from that were effectively, I would call it proxies for institutions, right? A lot of aggregators that were already in the space. But you guys came with a different perspective. And one of the key things that you guys were doing when we first met you was you were investing in your origination counterparties. You weren't acting as a pure aggregator, like you said, betting on different groups. And I've interviewed some of your, I guess, I don't know how I put this, clients?
Portfolio companies.
Yeah, exactly. Portfolio company. We've interviewed some of your portfolio companies. And so it's all on your website, so it's public record. I mean, we interviewed your friends over at Renovo and friends over at Builders. And talk about that really quick, because that's a very different perspective or strategy in our industry. It's starting to become more of a kind of common theme now. But back in 19 and 20, it really wasn't thought through by a lot of, I would say, your colleagues and competitors, but you guys started very early with doing that, right?
Yeah. So my background is mortgage-backed securities trader. I was a subprime non-agency mortgage-backed securities trader. I was an ABX and CMBX trader. I was at Merrill Lynch, Bank of America, Royal Bank of Canada, and most recently, prior to Saluda Grade, Baird. Mm-hmm. And the things that we were focusing on were trying to find esoteric, interesting, higher yielding, real estate related, asset-backed related assets for all of our client base in the institutional capital landscape. So money managers, banks, hedge funds, pension funds, mutual funds, et cetera, were dying to find higher yielding assets and interesting ways that they could find yield. So 2017, 2018, we started venturing into the fix and flip and transitional mortgage landscape. And we started meeting incredible entrepreneurs. Kevin Werner was one of the first, and Renovo Financial was one of the first really talented lending operations that we met in the private lending world. And it became so clear to me that asset managers many years down the road, 2019, 2021, would be so desperate for collateral, so desperate to access the yield that was inherent in the private lending world, that they would need to move further and further up the chain to own their asset origination channels. So, we've always been, or me particularly, I've always been interested in investing in early stage, mid stage growth equity into private companies. And when that was more of a personal passion and hobby of mine, doing it on the side outside of my sales and trading and banking career and fixed income. So when I saw the opportunity to start to back some of these small to mid-sized platforms, and I saw the clarity of the obviousness of being able to deliver them institutional capital at scale via institutional partners like insurance, mutual fund, money managers, but really where I knew that the whole equation would end up and really start to get very big was securitization, which is what our bread and butter was. And my partners, Tim Carr and Brian Brennan, really the DNA of our whole institution and our whole company is the securitization market. So we knew that was where everything would end up and where everything would want to go. So in 2017, 2018, we started creating a lot of those types of relationships, and really through the lens of being able to bring, our partners, our clients on the banking and trading side to these companies like Renovo Financial. When I saw when I kind of realized we could spin out and do this ourselves, we launched Saluda Grade. I launched Saluda Grade January 2019, eventually brought Tim and Brian, and now we're a team of 26. To Saluda Grade, and we really started building upon relationships that we are creating with amazing entrepreneurs like Kurt Altig over at Builders, Kevin Werner over at Renovo. Those are the two that you mentioned that you've interviewed. But when we realized that we could both back them on the equity side and bring them cheaper and more scalable, better capital markets, debt capital market solutions on the asset side, we saw a perfect partnership, and that's really what the DNA of Saluda Grade is.
Yeah, and it was such an interesting approach to things, because until then, it had primarily been aggregation and securitization as the primary avenues. There wasn't much of a conversation of we're going to also put our money where our mouth is, and be on the cap table with you guys as a partner. We had heard of different, acquisitions, but we hadn't heard of kind of the same party that was helping them scale on the capital market side was actually putting their, money where their mouth is when it came to the sponsor. Because you guys were investing directly into the company, and you guys were really betting on the sponsor. What were some criteria? Because, what's funny was, when we interviewed, Kevin and Kurt, they talked about scale and multiple stages in their company's life cycle, and it was right about when they had started working with you that they kind of hit that critical mass. But what were you looking for specifically in these counterparties, right? While you were planning this I guess new venture for yourself and your partners.
So Jay Ford, head of our origination sales, has been instrumental in helping us build all of these relationships. So we've probably gone out and met 400 plus, 500 plus private lenders. And we've done transactions and helped probably 40 to 60 of them either somehow access cheaper capital, through loan sales, or we're buying loans from them. So we've met a ton of the players in the private lending space. And very much through our partnership with you, either us sending them to you for needs on the legal side or vice versa. So the things that we're looking for when we make an equity investment in a portfolio company in this space is generally a 5 to 10 year track record of great lending, great performance on the loans that they've been lending. But the biggest thing I think that we really look for is a risk-taking mentality, that they're either lending their own money or on behalf of their own investors of capital that they've raised.
Yeah.
I think that's a DNA that's infused inside of their underwriting, and the fear of losing a dollar of their own money or another investors that they've brought into their platform. That fear has driven them to a higher level of standards on the underwriting side and a better credit quality in their loans, versus what I think, there's a lot of participants in the market that are kind of originate to sell. And we work with a lot of those lenders too. So I think that we've seen that the lenders that have been really, in a longer duration in the market, raising capital on their own behalf to lend out to their clients, those are generally the type of lenders that we are trying to look to back and invest into. Inherently, those are also
a really good point, though. That's a really interesting perspective, because not everyone talks about that the way you just put it. Is you're looking at their perspective. You're equating the fact that they're lending out, quote unquote, their own money, and that equates to a higher credit standard. I like you to expand on that a little bit more, because that's something that I'm very passionate about. We represent a lot of balance sheet lenders. I represent, a lot of clients with funds. Can you expand on that a little bit more? Because I know all of them have had that. All your portfolio companies have that in their toolkit. But talk about what specifically about that are you evaluating? Because it's really important to talk about.
Right. If you think about the evolution of the industry starting in 2010, right, post financial crisis, shutdown of banks. And all of them, Renovo, Builders, Pacific Private Money, kind of all of them get started around 2009 to 2011.
Right.
Right. And they're all entrepreneurs. Mark Hahn, incredible entrepreneur, CEO of Pacific Private Money, Kurt and Kevin Warner, those are our three portfolio companies now in this space. And we're currently, doing other things with a significant number of others. But all of them kind of get started around that same time frame, right? See the opportunity from an entrepreneurial perspective. They immediately start to raise capital to take advantage of that opportunity. And then that begins a 10-year journey, right? To be able to build a firm that is looking through the lens of the private lending market, through the lens of post-financial crisis, and saying, hey, we understand the risks. We know what we're going to be able to try to avoid, and we have to protect our capital, protect our investors' capital during that time period, right? So what we're looking for businesses that evolved, right, with that underwriting mindset. But there's always that trick, right? There's always that kind of that balance point of when, how do you scale a business with retail capital, right? With balance sheet capital, as you call. But at the end of the day, the vast majority of those evolving business models through the 2010 to 2020 really reach a point, catalyst point, where you're saying, hey, they have to start to take institutional money. So what we generally look for when we're trying to make a portfolio investment or a private equity investment is somebody with that underwriting DNA that they were always trying to identify risks. Because what that did was that also trained their borrowers, right? Business purpose lending is so different than owner-occupied lending. So the majority of institutional investors, mortgage-backed securities investors that are coming to the business purpose, RTL, transitional lending, private lending, whatever moniker that we all call it, right? They're all coming from an owner-occupied landscape previously, where they were usually trading and buying mortgage-backed securities that were backed by owner-occupied loans, right? Business purpose loans are exactly that. Business purpose loans to business-minded entities, right, that are using that capital to transition a real estate property. And at the end of the day, there's so much underwriting that goes on the personal level of that borrower, on the experience level of that borrower, right? That's I would say far that you can't find on a loan tape. That it's far more qualitative than quantitative, right? So as quantitative mortgage-backed securities investors come into the space, right? The underwriting has to be done at the originator level, right? Because then it goes down to the borrower level. So we love to find originators that have 60, 70, 75% repeat borrower rates. And even as they grow, maybe that drops because of new volume and new borrowers coming into the system. Maybe it drops to 55 to 65, right? But we're really trying to target those people that have been training their borrowers and also learning from their borrowers, right? To be able to deliver them a first-class lending experience and be able to facilitate their business that they keep coming back. But it's that synergistic relationship between the originator and the borrower that they've grown together during that 10-year period of the company and the lending that we're trying to get a feel for during our underwriting of the firm and the platform, and to understand how they underwrite on the asset level and really more so on the borrower and the developer, real estate investor developer level.
So it ultimately does boil down, because and this is a good transition to ask you about the securitization product that you guys are offering doing, but that translates ultimately, because it boils down to the quality of the loans. The quality of the loans the quality of business, quality of the loans, quality of the borrowers ultimately also helps and adds that value to. And I'm guessing part of the conversation that's being had with these portfolio companies as you evaluate them from an investment standpoint is also to talk about securitizations. And so I want to talk about that because, when you guys came on the scene, it was interesting. To me, I was very kind of, wow, you guys have really turned the concept of securitization on its head, in the sense that you don't have to, like the first few that you guys did, especially, you guys gave access to folks that normally weren't even thinking about it and didn't think that they were an eligible candidate, but also made it relatively straight. It made it easy for them. The way I talked to them about it was like, there were some challenges, but still, like the fact that they were able to access that with a lot less red tape compared to what they had explored previously, or what their friends and colleagues had gone through, was fascinating, right? And when you guys put out the press releases on it, I kind of talked to you guys and your team members about it, learned more about it, and read some of the documents. And it was very interesting because it wasn't your average securitization that you see in either RTL or DSCR, right? It was a little bit different, a little bit unique. And so, can you expand on that? Your kind of your journey in offering those products to your clients and your counterparties in the space, and how you guys have kind of influenced the market when it comes to the securitization products that you're putting out there.
So, like I said, our team has been doing securitizations, and Tim Carr, our CIO, has been, investing in securitizations for 20 plus years, structuring residual tranches, equity tranches, building a whole capital stack. And all of us have been trading and transacting, trading, selling, all of these different types of structures. So when we moved into the private lending world, we were very much a fish out of water, right? It was like Tim Carr is Michael Jordan playing basketball, wins 3 titles, goes in the private lending world, and he's playing like single A minor league baseball, right? So when we got to the point where we were raising our own proprietary capital inside of our asset management business, and we had the ability to go back to what we do, it was like bringing Tim Carr and all of us back to the securitization market. Was like, all right, we know this is what we know what to do, right? So since then, April, we launched our asset management business in April 1st of 2020. Brought our first securitization in July of 2020 with PAC 1, which is Pacific Private Money. And we've since rattled off 15 securitizations for over $3 billion of issuance. Fantastic. And almost every single one of those securitizations had a first-time element, first-time type of collateral, first-time structure. And so what we were doing was really using all of our past experience, which is vast in the securitization world, to say, okay, let's go solve the problems of our clients, of our partners, and really of our portfolio companies. Let's go solve the problems and adapt it to a new market that we know so well, right? The same way, very much, by the way, the same way that a ton of the private lending world goes and solves the problems of their borrowers and their clients, trying to solve, and so what we were identifying was, no banks really are currently. So the traditional way that people bring securitizations are you aggregate loans with a lending line, right? That lending line is generally very restrictive. Turek started doing this, and John Beecham, give a ton of credit to John to the success that he's been, institutionalizing this as an asset class inside of the bond market. He had a ton of help, obviously, from KKR to be able to help bring the banks that they brought to Turek. They gave Turek, backed by KKR, a decent amount of aggregation lines. Right, so KKR backed Turek, starts buying fix and flip loans, and that's where the start of the securitization market in this asset class really kind of got off on a great foot. Really led by John. What we were trying to do was adapt what the progress that they had made to really what we have, a couple of different business models, right? Pacific Private Money, for example, does business purpose transitional loans, but they also have a very extremely useful owner-occupied bridge loan, right? That helps metro owners, LA, San Francisco metro owners buy their next home before they sell their first home, right? So that's a totally different owner-occupied loan that's just very different from anything that had been securitized previously. It's usually a 4 to 7 month duration loan. So we were able to marry that along with a business purpose loan inside of a 2-year revolving structure. So we brought that in July of 2020 with our partners at Raymond James, who were very helpful for us. So that was a very innovative thing that kind of kicked it off. And then from there, it was, once I had that, we all had that aha moment at Saluda Grade that we can start pushing this forward. We've rattled off 15 different securitizations. The next one in the private lending space. And by the way, we were talking about lenders before, but the other one that's highly involved and extremely embedded in the private lending world is Alpha Flow, right? Ray Sturm there and Noah Martin are two great partners of ours that have been, I think, really pushing the envelope and trying to change how the smaller size lenders in small and big size lenders in this landscape access institutional capital, and they do that through a highly accretive tech-enabled platform that Alpha Flow delivers. So in January of 2021, we brought a very interesting, unique, first time ever warehouse line securitization for Alpha Flow. Got them $100 million warehouse line securitization, and I wrote a little bit about this on LinkedIn, and so did Ray. But Alpha Flow obviously is a fintech, VC-backed platform, right? Doesn't have a ton of equity on their balance sheet, and the majority of Wall Street banks that are going to give aggregation lines to someone like Alpha Flow need to look through and see a certain amount of equity. Yeah. Alpha Flow didn't have that. We needed to find an off-balance sheet solution for a warehouse line, and we created that via the securitization market. So we did a $100 million line that's functioning today to allow Alpha Flow to go out and quickly close loans, be able to buy it into that vehicle, aggregate to critical mass for certain institutional investors that they work in on the back end, and be able to pool up certain critical mass loan trades to be able to sell into their institutional investors. So that's just that's just a few of type of examples of innovative and unique securitizations that we've designed to be able to solve problems that we identified inside of our portfolio companies and our advisory clients. And we've done a bunch of other things that are unique that it would probably take up the whole show. But really, the other thing that we do that I think it's just valuable, and it's something that I try to talk about with our banks, our lawyers, our legal, et cetera, is that private lenders work fast. That's the value add that they deliver to the ecosystem. Real estate investors are looking to get things done now, be in and out of a real estate market today, tomorrow, soon, gone, on to the next, right? And that's the same way that we like to work. So we've closed the securitization in 23 days, soup to nuts, 23 days. And that was a $300 million plus securitization of a relatively first-time asset class that we brought. And really what it did to us was it pushed us to push our counterparties and push our teams to move faster, to be in and out of the market quicker, to be able to do more for our portfolio companies, our issuers, and our originators, et cetera. So, those are one of the things that I think that we will continue to try to do. So we're trying to bring 2 to 3 deals a month. The pullback in rates, and we can talk about that. The pullback in rates starting in January, and the Russian conflict has caused a huge amount of friction and slowdown in the bond and issuance markets, which is widely covered and discussed. But with that will continue to be our mantra, is to help our portfolio companies to move fast and increase volume. And anytime that someone's talking to Kurt and you've seen the origination volume increase, and Kevin Warner over at Renovo and the increase in their origination volume, I think it's much to not only their ability as entrepreneurs to build businesses that can scale at that rate, but it's also their partners in the capital markets to be able to supply them with the gasoline to go faster.
And that's an interesting point you make. I mean, you're translating the values and trying to match those types of values, business values, that you're identifying in the private lending space, and trying to make sure that you kind of speak the same language, if you will, right? And as it pertains to speed. But from my experience, it's when folks from the institutional world, from Wall Street, come to our space, they tend to kind of bring their mentality to the industry and force it to slow down a little bit. And that's actually been real. We've seen your average closing time in our industry has gone from what used to be a couple of days to about a week or so, right? And so, that is, and also different types of requirements. But what I'm hearing from you is that you're trying to match culturally to them and provide that kind of parallel relationship so you're speaking the same language. But when it comes to securitizations in general, they're not that. I mean, generally speaking, they're not that quick. Especially when you got all these different counterparties, different agencies, different rating agencies, different leading investors, bankers, all these different folks are involved. Have you guys approached it differently than your average institutional securitization? And has that allowed you guys to do it fast, or is it the same product and you guys are just really, really fast and have it all locked in advance?
So now I know why you are the world's only lawyer with his own logo. I don't know if you can already see that. Kevin has produced swag with his own icon. And I think everyone that knows you is that you're not just a lawyer, you are a personality, but also extremely good at understanding and getting to interesting points. So the answer is yes. First of all securitizations in the fix and flip RTL private lending world have been unrated, will probably continue to be unrated for a number of different reasons. So there isn't that slowdown from the rating agencies, but anyone that I would say that listens to this show and is trying to understand if longer term their platform can be adapted to a securitization model, they should understand that aggregators are truly at the whim of their lending and financing counterparties. Right? That they buy and then they finance those loans. They finance in an aggregation model to be able to deliver term financing, which really is, securitization is a funny word, and sometimes it's spelled wrong with a Z. You can make an argument either way. In Britain, it's not with a Z. But the concept of the idea of securitization is simple. It's just term financing, term final permanent financing for certain asset classes. I'm sorry, for the end bottom part of the capital stack to be essentially the levered investor on those assets. Mm-hmm. So to get to that point from A to B, to acquire loans over a certain period of time, that's an aggregation, and they work with usually Wall Street or commercial banks to be able to finance those loans to a term takeout. So, really and that's what we saw during COVID, right? There were a lot of financing counterparties that just shut down and stopped the aggregation, right? And that's why a lot of the aggregators paused. Right. And again, nobody's fault on the aggregation side. It's just really the way that the system's been built. So when you think about the slowdowns and the friction and all of those different things that are inherent in the aggregate to securitize model, it is what it is. It's just part of the ecosystem. It's part of the model. There's a couple of different ways that we've flipped that on its head. We usually deliver securitizations that are a little bit different and just different.
Well, I mean, if I put my lawyer hat on, a little bit different, very different, and a lot of people are talking about it like, oh, that's a different way to like. We had a lot of folks that have been through that before, and they were kind of like talking about how interesting, how different it was. And when we were on a panel too, like I think afterwards, like John had been asking you about your products and that kind of stuff. So like, you're being humble about it, but it's very different than what I'm used to seeing, and it's very streamlined in a lot of ways, because the documents, to me, I read them like they kind of removed. You guys kind of removed a lot of the. I mean, fluff's the wrong word. Kind of the fat, I guess you can call it. It was very, very interesting how you guys attacked it. For our audience who is not familiar, kind of like give them, I guess, the layman's version of what that means, because it was, I mean, you're being humble about it, because I saw them and I was like, this is so unique. This is so different than what I'm used to seeing with when Turak does it, or whoever else out there is doing it. So like, give us a little more color on that, please.
Yeah, I mean, we don't need to go into too many details, and I'm not trying to be humble.
Don't give away the secret sauce for sure.
Yeah,
right?
no, it's not even that. It's we're trying to deliver differentiated capital structures, differentiated financing tools to our portfolios and counterparties, right? So when we left the traditional banking world and we came back to it with the mindsets of, as entrepreneurs, building platforms, investing in those platforms, we have become partners to our originators. We have learned many things from them. And one of the things that we've learned is, why not? Why can't we? Right. So when we're asking these questions to lawyers and structurers and bankers on when we're issuing our securitizations, that's the questions. Why not? Why can't we? We're going to do it this way, and we're going to move forward because it just makes more sense.
So you're pushing the envelope on their expectations too. So I'm guessing you probably got some pushback from your bankers then, right?
Well, bankers are
they only like what they're used to, right? So that's kind of
everyone would rather work on a legal document that they've worked on previously.
Exactly.
Right? So we have a phenomenal team at Denton's that's been with us since the beginning, and they're just as creative as we are, maybe definitely more so. So we've pushed them as hard as, and they've pushed us. So we've just taken the entrepreneurial spirit that we've learned from our partners like Mark Hanf, Kurt, Rob Trent over at Builders Capital has become a big mentor of mine. Kevin Warner's become a best friend. So we've learned from them to say, why can't we? Actually, we're going to do it this way, and we're going to move forward. We're going to find a path and forge a way forward that's just different.
Trying to find a way to say yes to people that you put, and make it happen for them, even though it's not necessarily.
And if you think about it, that's what they did from 2010 to 2015, where there was literally no capital for their best borrowers that needed to do projects that they knew would have fat margins, right? They needed to find a way, right? So that's what we're doing for them. And we've learned a ton from our partners, and we've become, I think, more, I would say, creative, because we have been forced to. And again, I've sat with Nomura, I've sat with CS, I've sat with every investment bank out there, and I say, new construction or this heavier rehab. In 2019, I was like, this is where the market's going. Are you going to get there? And they say, and they make the joke, they go, we'll get there after you securitize it. So, slowly after we're opening the channels of some of the things that we've securitized that have never been securitized, I think banks will catch up. We'll get more traditional aggregation lines in place with a more deeper, broader set of financing counterparties, and that will open up the market for everybody, which will just be the way it'll work. And I'm glad it'll work that way. But at the end of the day, I think that we are forging a path forward the way that John Beecham forged a path, back when he launched Turak, and the way that our portfolio companies have been forging a path and offering differentiated capital solutions for their partners for many years.
I hope you're enjoying this episode so far. I wanted to take a brief moment to tell you about Gerasi, the nation's largest law firm dedicated to the private lending industry. We have 3 legal departments vertically integrated to serve a private lender's business. We handle everything from licensing to new entity formation, fund formation, loan documents, national compliance, litigation, bankruptcy, foreclosure, and so much more. We pride ourselves on giving our clients the ultimate peace of mind. Check us out at jurasilawfirm.com. In addition, our internal conference line gives opportunities to you to network, learn from industry leaders, pitch to capital sources, and make new connections. Visit jurasicon.com for more information about our upcoming events. That's GERACICON.com. I guess one of the I want to segue into kind of what you hinted at earlier is kind of current, I guess, troubles or pains the market is facing in private lending, and you guys have a unique kind of perspective on things with your background and your involvement on these different assets. But I first want to ask, are you guys doing the same thing with the DSCR product? And are you doing and actively involved there, or is it kind of something you don't really touch? Or Because that's kind of a good segue to talk about market volatility right now. So before we get into that, I want to ask about that. Have you been doing that at all? I actually did not inquire.
Yeah. So we're actively buying DSCR rental loans now. We were not as involved in it versus bridge, classic fix and flip and new construction previously. I think it's a valuable differentiator for not only all the aggregators, but I think it's an awesome product for all of our lending partners as well, because it's also a hedge, right? If the owner-occupied market, if you're preparing all these homes for first-time home buyers or owner-occupied borrowers, and mortgage rates go up, right, and first-time home buying slows down, and they become renters, et cetera.
Yes.
Then you have a takeout for that bridge loan inside of a termed-out investor loan. So we love that concept, and we've become more bullish on the bridge lending asset class because of that the proliferation of that term takeout.
Right.
So yeah, but everyone has seen that with a longer duration in a true fixed rate mortgage, right, versus a short duration bridge loan, there's a huge amount of rate risk that I don't think a lot of counterparties fully understood going into November and December. Yeah. And frankly, it was one of the reasons why we hadn't been that big in it.
So you were worried early. You were worried about rate volatility very early.
Well, I mean, again, we come from longer duration owner-occupied mortgage asset, right? So
before you saw
So Brian Brennan, who's our whole loan trading senior portfolio manager, has been buying billions of long duration mortgages for a long time, right? So hedging mortgage conduit is very, very tricky and very hard. Right. So it was easy and fun to just buy 1 year duration mortgages, and be able to not really worry about rate risk, et cetera. But when you move into, to trading longer duration, and obviously the majority of the aggregators in the DSCR product are very sophisticated mortgage shops that understand rate risk. But I just think that it got so, like all things, right? When it gets so mundane and you're buying, you kind of lose concern. And I think that we saw a huge fracture in that market between December and February. So it's starting to kind of settle down. I know that there's been some losses, and there's been some, people have taken some licks. We definitely didn't have everything perfectly hedged, and everybody's been kind of caught off guard by a massive rate move that is unprecedented. Right. So, but I think that that product's not going anywhere, right? The undersupply of housing is so bullish for a lot of different things, but the millennial generation isn't going to all become homeowners all at once, right?
No, 75 the way they are right now.
Yeah. So, right. And I think it's great. It's great because the end real estate developer investor, that really is the lifeblood of the client that we're trying to, all service as capital markets participants, as lenders and originators, right? To see them be able to grow their business is really the end key. And that was one of the things Kevin Warner really harped on very early with me, teaching me about fix and flip in this asset class, was if we do right by our clients and we grow their business, we will win. Right. And that's why you've seen Renovo win. And that's why you'll see. So I'm excited about being able to offer them a product that in theory will allow them to be able to grow their company's balance sheet and their personal wealth by becoming a landlord, or essentially an owner of rental properties over time. It'll differentiate and diversify their business. So it's an exciting, but again, that connection from the end securitized product down to the end borrower is how we think that whole value chain. If you're adding value all the way through, again, you'll build really significant businesses in the lending origination and platforms like Renovo, builders, et cetera. Right. So that's why I'm so excited about the asset class as a whole and our ability to participate in it as a value.
And that is an important thought process to think about when with our audience who's doing a lot of our listeners have, they added the product a couple of years ago, and they started massive volume in it, and they started concentrating on it. And now they're kind of looking back and said, well, maybe we should do some more RTL, more flips and more construction loans, or do commercial or whatever have you. And it's been kind of a hot button topic, I guess you can say, is this whole rate issue, and the volatility and concerns in the DSCR market. And we had a panel, and it was kind of funny because at Innovate, and one of the things was, it was kind of funny because from my perspective, and I kind of agree with the panelists in the sense it didn't feel like it was a doom and gloom panel, and then I talked to some clients and some attendees, and the recipient, the feeling about it was still like there's a lot of uncertainty, and we're, as an originator, they're not quite sure how to approach this anymore because, their perspective is there's not enough room for them anymore. There's not enough margin for them anymore. And what's fascinating about it is that, no one really knows where we're going to end up. Everyone kind of thinks it has their own perspectives on it. And I want to ask you about this because, when you were on a panel with me a couple of years ago at Innovate, you had some really interesting perspectives on the impact of the feds and just the federal government's kind of assistance during COVID and how it helped us get out of it. I'd like to hear your thoughts on this now, where we're headed when it comes to this rate environment, because some folks are in very, very well known and very big companies are predicting a pretty hefty rate situation by the end of the year, and they're nervous. And so, and some are very concerned, and others are saying, you know what, we're going to be okay. It's not going to be that bad. And I just want to get your thoughts on that.
Well, it's a multi-layered question.
Yeah.
Jerry Rice said, do today what others won't, so tomorrow you can do what others can't.
Right.
And I think what you're talking about is over the last 6 months, because of the rated securitizations that we're allowing market end investors to pay such a high premium for DSCR loans. It was a phenomenal originate to sell, immediate gain on sale business, right? That drove a huge amount of profits and revenue to your private lending constituents, right? So what's happened now is that margin has collapsed. Right. And the market doesn't have as deep of a bid. And there's just been a complete chaos in the capital markets as interest rates have moved 300 to 400 basis points. When you think about the addition of both the rate curve and credit spreads, right? So we've seen about 300 basis points widening of rate and credit spreads. So when you think of how that again, it's always a trickle down effect, right? And how end investors are able to finance and how they, in relative value in the capital markets, how that trickle down effect impacts originators and then also end investors, right? So when I say do today what others won't, well, so tomorrow you can do what others can't. What I think that you should be focusing on if you're a private lender is building a very differentiated lending business and thinking and helping your end clients understand how they should be focusing on different parts of the food groups, right? You should be focusing on rehab. You should be focusing on customers that are now going more new construction. And you should also keep your ability to deliver a term takeout for either yourself or for other people that want to have longer term, ownership of rental properties, right?
To serve the client, like you mentioned, like Kevin was saying, to serve the client's needs and help them grow, right?
Because
the end borrower.
Right. And for the same reason at Saluda Grade, why I tell all of our capital markets participants and our counterparties, don't let us be your only buyer. Don't let us only be your only capital market solution. We want you to have a diversified capital stack underneath you to prepare for some of the things that we can't always prepare for, right? For the same reason we tell them that, right? They should be telling their clients and they should be looking at their business as not only a diversified outtake of capital markets, diversified capital stack and investors, a mix of balance sheet lending like you talked about, right? And also the ability to originate and sell, right? You want to have diversified outtake or capital markets. The same way you should be trying to advise their end borrower clients and their customers to really have a diversified takeout as well. Right? A diversified revenue base.
Yeah, irons in the fire. I mean, we've been talking about this for years, for a long time, but ever since COVID, I've been stressing the point is you need to have a diversified strategy. I mean, I've been stressing it on the capital side, but I've been telling clients the same thing with the products. The nice part.
But would you agree that you've seen a lot of people kind of move to what's hot, right?
Yeah, and DSCR was the scary part. And we had an interview with Sharon over at 1829. She was very like, we don't touch that because it's not conducive to our end investors' demands. but she was concerned about it. And it was funny because that episode aired right at the tail end of season 2, which was like right when the rate hike started to happen. And it was funny because one of her sellers called me and was like, when did you ask him when we filmed that? We filmed that in the summertime, and it was like she had kind of called it, and a lot of folks were deny. It's going to be fine. It's going to be fine. And I was like, logically speaking, this doesn't make any. If the rates go up, this will go up too. Fix and flip construction, it's a different market. It's a different world.
Well, no, those rates are going up now, and that's
well. And I was going to ask you that, like,
yeah.
So with DSCR going up, right, and rates climbing, what's your thoughts on how
it's been amazing. I've had so many bridge lenders call me. They're kind of shocked that fix and flip rates need to go higher. And I go, well, your friend that's buying a house down the street right now, they were getting a 2.5 or 2 3/4, and then it was 3.5 mortgage, prior to this rate move, right? Where's their mortgage rate today? Well, that's different. Well, okay. Well, why is that different? Right. Okay. Well, it's longer duration. You can make that argument. Yes. Right. But then when you talk about the 2-year part of the curve, how much is the 2-year part of the curve up? Right. And then when you talk about where the securitized bond market, this is all public, obviously. Right. We issued senior bonds off of our RTL securitization, our first one in November, right? It was 2.25. Our second one in January, it was 3. Right. And now we're issuing stuff and MFA's deal just got 5 1/8.
Yeah.
Right. And now NPLs, which are really kind of the unrated barometer kind of the bellwether of unrated securitization, senior bonds. NPLs are kind of in the market. Predian's in the market now with a 5.5 to like 5.8 price talk. Right. So what we've just seen is that senior bonds off of these securitizations. And again, you can talk about weighted average capital stack, cost of capital, et cetera. But just look at the senior bonds, 2.25 have gone to 5.8, right? And now fix and flip guys are saying that rates should be like, they don't believe that rates should be higher. So we've been working along all of that and really trying to send information out to our ecosystem to understand what's happening, daily as things have widened.
That's good.
Right? And we've been pushing them to make sure to instruct your borrower. Nobody likes to call one of their best clients and say, hey, we got to charge you more. But every single bank in the country is doing that now with the mortgage rates up, right? So it's the
costs
way
have gone up. They've gone up.
No, it has. No, yeah. I would say
everything.
It has. So I think that guys are starting to fix and flip and new construction are starting to move about 100 to 150 basis points.
And that was an interesting. I was talking to some folks recently at our last event, and I was talking to them like, guys, like, we all remember when mortgage rates were at 7s and 8s. I remember when I got out of law school, my student loans were 8%. It wasn't weird for us at the same time. Fixed income was at 12 and 2. Like, that was the market at the time, and partially because there was no institutional access, but partially because there was mortgage rates were high. And so,
again, so it's all about sources of capital, right? So
agreed.
there are 3 different types of source of capital, right? There's insurance, right? There's money managers, mutual funds, asset managers that kind of raise, middle duration money that currently, kind of, I would say, are in the high, mid to high singles, yeah. Right? And then there's mostly private equity and or hedge fund money, right? So those 3 buckets have 3 different costs of capital, right?
Sure.
So when you think about where you can get the most amount of actual firepower, really it's through securitization, right? Because you're taking the hedge fund money and you're multiplying it, or really by 8 to 10 times,
right?
And that's how levered the majority of the securitizations are. So when you think if you think about those different food groups again of investor bases, the largest bit of firepower until the insurance companies really lean into new construction, and they haven't yet. Right. Until they really lean into new construction, you're still going to see the majority of the firepower of capital that's pointed to this asset class coming from those levered players. Right. And it doesn't matter what you think of where things should be. Right. Interest rates are where they are, and they are driven off of what the Fed will do. And then all of those things stack up on a risk premium basis. Exactly. And then it comes down to where people will finance loans. So if you don't think it's there, if it hasn't happened in your lending business, it should have already happened, mm-hmm. Right? And if you had been paying attention, you've already been raising rates, and you probably will be raising rates more. But yes, it goes back to when we got out of college, Kevin, like LIBOR was 6.25. right?
That's what I'm saying.
And it was 6.25 for a long time.
Yeah.
So, it's hard to forget that. I mean, it's hard to remember those days, but if you think about historical interest rates, we are going higher, and that's what inflation will drive.
Right.
So,
and I were talking to folks, and I noticed kind of the ones that were more stressed out than others were the ones that didn't have. And same story from COVID. I feel like they didn't have captive source of capital, had a reliable source of capital, however you want to put it, and they were concerned because it was so volatile because they may pull out at any given moment. Where are we, and from your perspective, are we facing another crisis like we did in 2020? Or are we just going to have to adapt, and we're going to just see a little bit of compression within the market when it comes to our client base, like the industry as a whole? We'll lose a little bit of activity, or is it going to be another crisis on our hands like we had in 2020?
No, it's definitely not a crisis, right? We're back into for COVID. There was a minute, right? There's a saying in the bond market: "There's no bad bonds, just no bad bonds, just bad prices," right?
Mm-hmm.
During COVID there was for many period there was no price,
mm-hmm.
right? So
we don't know what the price should be. No one knows.
Well, no, and that's what's caused a lot of the slowdown in new issuance. That's what's caused the slowdown of, I would say, overall liquidity. But as things kind of settle in and people get some sort of visibility, there's a massive amount of cash on the sidelines, right? For the same reasons that everybody who didn't care about fix and flip, in 2017, 2018, has now been studying up and trying to get into the market.
That's really strange to me,
right?
Because I've been living in this space for so long. The fact that there are still institutional players out there that are now learning about this,
trying to now look at it.
And it's like, I'm just like flabbergasted by it, because, like, man, I mean, late to the party much. It's a bit of a late entry, but they're making very interesting moves.
I mean, people are still going to have the same. It's not just it's still a yield problem, right? We're still in historically low, a yield curve. So it's for them to be able to go find yield and be able to go find assets, it's still going to be a big problem. So everybody is focused on alternative assets and going to esoterics, going to what they call private credit, and this is very much private credit. Right? You're literally lending to a business to transition real estate, and you're backed by the real estate. That's why we love it so much. But at the end of the day, this is the definition of private credit. And now that people have been smoked on growth equity and the equity markets have pulled back, we're seeing a lot of allocators and a lot of LP and a lot of asset managers now trying to go find alpha in different sources, right? So they will be coming back to fixed income. And now that the nominal rate curve and the interest rate curve has come up, right, they will be moving back into fixed income. So this will be a place that there will be more and more interest. So there's no crisis. It will be harder for a certain amount of time, and it will cost more. But if lenders are smart, right, and they can educate, because again, at the end of the day, right, these are usually 9-month loans, right, and addition 1 or 2 points on overall cost of capital to an end borrower doesn't necessarily change their margins, right? They're just nobody likes to pay more, right? But if you are educating them and continuing to differentiate on service, on how you provide, helping their business grow, the same way Kevin was trying to always teach me that's how you build your lending business, is you become so integrated in the developer investor's business model that that you don't win on price, right? You win on service.
Right.
So, getting back to basics and competing on service and having them win, not focus on prices, is really something that I think a lot of lenders will do. And then they'll be ahead of the game. Right. So if they're really pushing interest rates higher, they'll be prepared for the fact that we're going higher.
Right, because they're going to rely on that value add customer service mentality, as opposed to your conventional mortgage banking mentality, which I'm seeing, starting 3 years ago, we started to see kind of whiffs of in our space, and like you kind of see that, I guess robo lender mentality, and then by the way, that's what scares me. Again, you can robo lend on owner occupied mortgages, right? You cannot robo lend on business purpose because of the massive amount. And I like to say this: the greatest risk in fix and flip lending is not the loan that you do; it's the loan that you do not know about.
right? It's your end borrower is getting over levered because they're getting financing from somewhere else, and they're working on projects that someone else gave them financing that they shouldn't have, right? And if once they get over levered, then they will blow up, and it doesn't matter whose projects they're working on. If they blow up, all of them are going to suffer.
The
right?
business is all connected inside of under one umbrella. If you're doing multiple loans with them, but this one really risky loan with a third on it, you got some problems.
And if you do robo lending and you do not know and you do not fully encompass and fully understand the breadth of your client's whole business, right, then you will run into trouble, and then you'll see cascading effects. Right. So
that's interesting, because that kind of it's I think that's going to continue, because we saw a lot of growth in companies that have that value that you're talking about, that kind of customer service mentality, and they have, a diversified balance sheet, diversified capital structures. Companies like, Renault was grown immensely. Our friend Noah in Arizona has grown immensely. Our friends over at Arixa have grown immensely. They've hit the B's now, in origination volume. And I think that you're right. Like this market will bear fruit for them specifically, because they're able to say, hey, borrower, things are mighty tight for everybody. We're going to have to come up a little bit on this one, and incrementally come up and increase the prices to match, and making sure that they're keeping up with the market. So
speed and ease. If you're fighting, if you know that you will win on speed, ease, and competency, not on rate, you will grow a great lending business in the private lending world. If you are focused on giving the best rate at all times and best price, you will eventually lose, because your customer base will negatively select you, adversely select you. You will end up with the guys that are thinking about things incorrectly, as opposed to people that are trying to build bigger, broader businesses for the long term.
Right, and that's so true with every group that I've seen scaled this past few years. Is they've all been taking that to heart. So, all right, well, we have to transition now, because we talked a lot about business, talked a lot about the industry, talked a lot about Saluda Grade, but I want to talk a little bit more about Ryan, because you actually have a very interesting story. Not everyone knows you were a college athlete, right?
Yes. Barely.
I don't know about barely, man. It's a pretty impressive story. The things you told me when we were watching that ball game about a year ago. So what'd you play in college?
I played baseball at Georgetown.
Very nice. Very impressive. And was there a point in your life where you're thinking pros, or you just was it a college thing? What was that? What was that like?
Like anyone that knows me, I am deeply passionate about the stuff that I'm focused on, and baseball was everything for a long time. And I had some great momentum, and ended up not having the senior year that I wanted, and ended up having a job opportunity at Merrill Lynch, and decided to hang it up. I'd gotten that minor league experience through the summers during Georgetown, and I'm obsessed about what we do at Saluda Grade. I'm obsessed about some of this stuff with private lending and home equity and technology and fintech. So I was easily able to replicate the passion and the obsession that I had with baseball previously. I like that. But I do miss the game. It's a phenomenal game. I miss all sports. I played a ton of different sports, but I have replaced the competitiveness that I loved about sports with business, which has been fun.
And I wanted to ask about what values have you, I guess, taken from athletics and competitive sports into business today? The competitive nature is what's quite attractive and keeping you motivated. But are there any other things that you've taken from your time as an athlete and have found to be incredibly valuable to business today in your current business?
Yeah, we love recruiting athletes at Saluda Grade. I think it creates a time management skills. Any college athlete, does the same amount of work that all the other college students do, but they also, by the way, have a full-time job of literally 50 plus hours a week. And 50 is low. There are times that baseball takes way too long at times, right? So Friday, Saturday, and Sunday can be 30 hours easily, 25 to 30 hours when you talk about getting out to the field, batting practice, setting everything up. So, we were putting in at times 40 to 60 hour work weeks alongside of being a college student. So I think there's an inherent work ethic that's embedded in college athletes. So we really love to recruit college athletes, and we have a bunch of them at Saluda Grade. One of the things that I found about Wall Street trading, Wall Street institutional finance is it is, especially in super efficient markets, it is hyper competitive, right? You end up making your profits on ticks, which are 1/32 of a percentage. If you can be, if you're literally fighting over ticks at different times, it ingrains a competitiveness into you that I think never leaves you. And that's why we have a lot of former traders at Saluda Grade, which is definitely the DNA of the firm that we're building. So, those two things really were, coming out of sports, work ethic, time management, passion, and competitiveness are the things I think that anyone learns in sports, and something that, I'm excited. I love competing, but at the same time, I love seeing other people compete. So my two brothers were, Brent and Darren, younger brothers, were college athletes at Georgetown as well. And I can tell you the most fun I've ever had, and my wife was as well. Kate was a volleyball player, full scholarship volleyball player at Georgetown. She had a way bigger scholarship than I did. But going to their games was as much fun as was ever playing in mine. So seeing my teammates, my friends, my peers and partners, seeing them compete inside of their arenas is, for me, just as much fun as competing in mine.
Very cool. All right, so we have some rapid fire questions I want to close out the interview with. This is a new segment for us, so bear with us. So these are going to be some quick questions, and try to think of it as a speed round. All right, the first question is, what was your first job?
First job, I was talking about this the other day. First company or first job?
First job.
First job. I ran baseball camps in high school. During the summer, I was running baseball camps.
Fantastic. All right. If you weren't currently where you are career-wise, what would you be doing instead?
Good answer to that would be in college, I was the only campus rep. I was an on-campus rep for Apple Computer.
Okay.
And the guy came to me after I'd worked there for a year, and he said, "Hey, I can get you a job at headquarters at Apple's headquarters in California." And I said, I wanted to go to Wall Street. So if I were not doing any sort of fixed income or traditional institutional asset management or investing trading, I probably would want to be in technology.
Probably in Silicon Valley somewhere, right? Yeah. All right. Third question. When you're not dominating the private lending world, what do you do for fun?
I'm not dominating the private lending world. I have a Churchill, Redwood, everyone, Turak. I think there are some big giants out there that we are constantly.
You guys are doing pretty well for yourselves.
To try to keep up with. So we are definitely not dominating. Builders Capital is dominating the lending world. So is Renovo. What I do for fun, I have two young kids. I have a 4-year-old and a 2-year-old. And if any parent that has those kids' age know that there's no other fun. It's work, and then you're hanging out with your wife and your kids.
Yes, I am in the same exact boat as you are.
I know you are.
We have fun by.
We're in Colorado now, so we do a lot of skiing.
Nice.
And we've been. My 4-year-old's now skiing, so it's been
your
fun.
Your 4-year-old is 4-year-old is skiing. That's fantastic.
Yeah,
that's awesome. That's awesome to hear. All right. What's the weirdest question an originator has ever asked you? You mentioned earlier you talked to hundreds and hundreds of originators. You've worked with hundreds and hundreds of originators. What's the weird question? What the weirdest one they've ever asked you?
I saw that earlier on the list of rapid fire questions, and I've been racking my brain since while you've been beating me up this whole interview. Can I come back to you on that?
It's fine.
Land banking. Right. So we have gotten recently a ton of inquiry around land banking. And frankly, we've had to go back to school on it to understand the economics and the mechanics of it.
Totally different.
So everyone is, and sometimes I don't think that they understand it. So the lenders come to us and say, oh, well, why can't we do second lien mezz versus equity on this? So having to rethink through capital stacks, but looking at it through the lens of like owning land and then thinking about the ripple effects of how the markets can shift home builders' demand, and then thinking through land banking has been, I wouldn't say weird, but I'd say one of the most challenging questions we've got.
And that's what I love about private lending is, especially before, I guess 18, 19-ish, like you saw all types of deals in this space, and it was just fascinating. And even to this day, we see all types of random structures and deal types that come to the industry and come to us as a law firm for assistance. And it's interesting to learn about new things. And I think that's always been part of the exciting part about our industry.
I've learned more in the last 3 years than any
right. Exactly.
That's a combination of running a business, starting a new business, expanding into new sectors, growing as a leader and entrepreneur, all of those different things. But I'd say from the most amount of complexity, the private lending world has the most, because it's the most bespoke, right? And so what I think that has been interesting about the institutionalization of the asset class is the homogeneity that we're forcing lenders to try to create with their borrowers. And homogeneity creates liquidity, right? So when things can get pushed down and say, hey, this is how it will work, and this is how it will work in the end bond markets, it makes people more efficient. And because the end borrower knows what to request and how to request it, the end originator knows how to process it, and then the end investor knows how to buy it, structure it, et cetera.
Okay, this is the last one, more of a business question. Well, I guess more like a entrepreneurial question. What's the one business tool that you cannot live without?
His name is Brad Hartung. Brad Hartung is one of the most hardworking, but also flexible, get it done, always, never, no. I mean, the number of all-nighters that guy has pulled since he joined our firm, the number one business value tool that I have in my life and that Saluda Grade has is Brad Hartung.
I wasn't expecting a person.
I
was expecting a tablet or a cool, notebook or something, but that's cool. Shout out to Brad.
Again, I think that anyone that's building a business, and I asked this question a lot too. We did it at our conference. We had 75 people here in Aspen. I'm sorry you weren't there, by the way, Kevin. We got to blame Jay Ford about that, and we'll do that after. But
for sure.
I was always asking everybody about productivity, and I want to know some app, et cetera, et cetera. But I think that everybody knows that building a business is so reliant on the team that you hire and you recruit behind you, and the surprise that we've had in the complete ultimate weapon that Brad Hartung has become. It's by far and away the thing that I should talk about the most. So
fantastic,
Brad. Thanks for being such a star.
I'll shout out to Brad. What a great way to close. I love it when we talk about people. People is what I'm passionate about, and the fact that we're closing on that kind of note is awesome. Well, I mean, that's all the time we have for this episode of Lender Lounge, season 3 with our friend Ryan Kraft of Saluda Grade. Thank you very much, Ryan.
Thank you, Kevin. You guys, and again, to throw it back out, you do an incredible job at Jurassic. I love that you have expanded on the idea of a law firm, and you've made a complete media company. So from an entrepreneurial standpoint, I have a ton of respect for what you guys do. And I'm constantly impressed with what every new thing that you are bringing out to all of us as partners and teammates of yours. So thank you. And thank you for having me on the call today.
Of course. And thanks for the kind words. And we wouldn't be able to do this without the love and support of our, clients and friends in the space. So I love doing this kind of stuff. And, for our listeners out there, look out for more from Lender Lounge and from Jurassic this coming 2022 and 2023. So we'll close out with that. Thanks.
Thank you, Kevin. Take care.
Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Jurassic. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.